You might not realize this, but if you are an NRI still using your old Indian resident savings account, you could already be breaking the law. Every year, thousands of NRIs get hit with FEMA penalties of 5 lakh rupees, 15 lakh rupees, or even more, sometimes for nothing more than keeping the wrong account open. In this video, we'll follow the typical journey of an NRI through Ramesh's story. Someone living in Dubai who needs to manage his Indian finances legally and efficiently. We'll cover setting up correct bank accounts, remitting large sums home, handling documentation and notarization, saving on taxes, avoiding scams, and everything else you need to stay compliant. Welcome to NRI Shala. I'm Malvika, and this is where we navigate NRI life together, from visa guidance and investments to maintaining your roots while building your future abroad. The first thing most NRIs like Ramesh don't realize is the day you move abroad, your regular Indian savings account becomes illegal to use. You must convert it to an NRI or NRO account right away. This requirement comes directly from the Foreign Exchange Management Act, or FEMA. This is so strictly enforced because the RBI and the government need to track the source and movement of NRI money for tax, anti-fraud, and anti-money laundering purposes, so keeping your old resident account while living abroad could potentially lead to severe penalties, legal action, and account freeze or closure. But what do you need to open an NRI or NRO account? To open an NRI or NRO account, you'll need to submit a range of documents: passport, visa, PAN card, overseas and Indian address proof, and crucially, get these documents notarized or attested. For many, this means physically visiting a notary or the Indian consulate abroad. Even though some banks offer digital KYC, attestation still usually needs a physical signature. Small hassle, but one you can't skip if you want full compliance. Else otherwise, you can be fined up to 3 times the amount involved, or 2 lakh rupees if not quantifiable, with an additional 5,000 rupees per day of violation depending on the adjudicating authority's discretion. So make sure you close or convert your old residence accounts immediately after moving. Gather all required documents and get them attested by an appropriate authority. Submit everything for compliance, even if it means a few extra steps. That's why, before Ramesh did anything else, he fixed this first, a step every NRI should take before planning the rest of their finances. Now settled in Dubai, Ramesh faces his next big challenge: managing his money across borders the right way. To do this, he learns about 3 main types of accounts designed specifically for NRIs. The NRI account handles Ramesh's foreign income. His salary arrives in dollars, the bank converts it to rupees, and the interest stays tax-free in India. Both the money he deposits and the interest he earns can be sent back abroad anytime without approval. The NRO account, on the other hand, is meant for managing income earned within India. Rents from his Mumbai property, dividends, or sale proceeds on Indian shares or mutual funds go here. The interest here is taxed at the standard Indian income tax rate of about 30% plus the applicable surcharge and cess. NRIs can also claim a deduction of up to 10,000 rupees under Section 80 DTAA if they are opting for the old tax regime. Additionally, by submitting a tax residency certificate, Ramesh can claim credit for taxes paid in India under the Double Taxation Avoidance Agreement, or DTAA, significantly reducing or offsetting tax payable in his country of residence. Repatriation of principal in the NRO account is limited to $1 million per financial year, subject to tax compliance. Then there's the lesser-known FCNR, or Foreign Currency Non-Resident Account. Ramesh finds this account perfect for holding deposits in foreign currencies like the US dollar or pounds, providing an additional hedge against currency fluctuations while also earning tax-free interest and allowing complete repatriation. However, unlike NRE or NRO accounts, the FCNR account only acts as a fixed account and not as a current account or savings account. To set up these accounts, Ramesh collected his passport, visa or OCI card, proof of overseas and Indian addresses, PAN card, and initial deposit via wire or check. Most Indian banks now offer a paperless digital KYC process, so he completed his account opening from Dubai using a secure app. He understood that NRE accounts can only be jointly held with other NRIs, while NRO accounts can include resident Indian joint holders, which can impact tax filings and operational ease. This feature is especially helpful if Ramesh has a family member in India, since a resident joint holder can directly access and withdraw money from the NRO account for household expenses or emergencies without needing to depend on Ramesh each time. With his accounts in place, Ramesh assumed his financial setup was complete. But it was only when he needed to move a substantial sum abroad that he realized just how important it was to understand the rules surrounding repatriation. The distinction between what you can transfer, how much, and what paperwork you'll need is far from straightforward. To make sense of it all, let's break down what these limits and exemptions actually mean and how they played out in Ramesh's journey. Soon after selling a property in Mumbai for 2 crore rupees, Ramesh needed to remit a large sum abroad. He discovered RBI's regulation. The principal amount from his NRO account can only be repatriated up to $1 million per financial year. But here's the good news. Interest, dividends, and rent, defined as current income, are not limited by this cap. Once he paid taxes on this income, he could send as much as he wanted abroad. Let's clarify. If Ramesh's rental income totals 2 lakh rupees yearly, he can transfer the entire amount once taxed at 31.2%, which is 62,400 rupees, typically deducted at source, not by his bank, but by the tenant paying rent under Section 195 of the Income Tax Act. The tenant must deduct this TDS, including surcharge and cess, deposit it with the government, and provide Ramesh the net amount. With the proper paperwork, Ramesh can then remit the full net rental income abroad without restriction. The sale proceeds of 2 crore rupees, however, are limited to $1 million per year unless he applies for special exemptions from the RBI. But are there any exemptions? In urgent cases, the RBI offers relief through documented proofs, such as medical emergencies abroad with hospital bills and doctors' recommendations, overseas education with university admission letters and fee receipts, foreign property purchase with legal agreements and payment proofs, court or legal settlements supported by official orders. To get approval, Ramesh filed Form 15CA online, attached Form 15CB from his CA, and added proofs of source, taxes, and KYC. He also noted the small but real costs, around 1,000 rupees for SWIFT fees, 2.5 to 3.5% in forex margin, and 2,000 rupees for CA certification. Planning ahead helped him avoid last-minute surprises. Despite meticulous planning, Ramesh soon discovered that navigating cross-border banking comes with its own set of digital dangers, many of which can catch even the most cautious NRIs off guard. The most alarming was the threat of SIM swap fraud. Criminals today routinely gather personal information from social media and data leaks, then impersonate their targets to telecom providers, getting SIM cards reissued in their names and taking control of their mobile numbers. With his phone number compromised, Ramesh's banking security was suddenly at risk. One by one, his OTPs, once a reliable safeguard, started landing in the wrong hands, opening the door to unauthorized access, large withdrawals, and swift money transfers before he could react. And SIM swaps weren't the only threat. Ramesh also had to stay vigilant against a rising tide of phishing emails, too good to be true investment opportunities, and property schemes promoted by unverified brokers, all cleverly designed to lure NRIs into traps. Determined not to be a victim, Ramesh adopted a layered approach to security. He switched from SMS-based OTPs to more secure app-based authenticators. He enabled real-time email alerts for every transaction. He made sure to keep his KYC documentation up to date. And he scrutinized every investment offer and property deal before committing. But technology risks weren't his only concern. Ramesh learned that letting an account go dormant could be just as costly. The RBI recently reported that over 3,400 crore rupees of inactive NRI deposits had been transferred out to government or investor protection schemes, often without the account holders realizing it. By making regular account checks, updating details proactively, and ensuring every account saw some level of activity, Ramesh kept his hard-earned money firmly under his control. Ramesh found himself caught between Indian taxes and those of his new country of residence. He feared double taxation, paying full tax twice on the same income. But Indian treaties with over 90 countries offered a solution: the Double Taxation Avoidance Agreement, or DTAA. By submitting his tax residency certificate, or TRC, and Form 10F annually, he could invoke treaty benefits. Using DTAA, he could claim tax credits, meaning the tax he paid in India could be offset against his foreign tax liability. For example, suppose Ramesh's 10 lakh rupees rental income was taxed at 30%, so 3 lakh rupees in India. In his resident country, the same income might be taxed at 24%. Roughly 2.4 lakh rupees. Without DTAA, he'd pay 5.4 lakh rupees total, double the tax. With DTAA, he claims a foreign tax credit for the 3 lakh rupees paid in India, reducing his total tax to just the higher one, in this case, 3 lakh rupees. So what do we learn from this? File the necessary forms, timely and correctly, so that tax credits are claimed without delays or penalties. These agreements vary by country, so professional guidance is advisable. For NRIs like Ramesh, managing cross-border finances is far more than ticking off compliance checklists. It's an essential life skill that demands legal awareness, strategic decision-making, and ongoing vigilance. The difference between safely growing your wealth and facing unexpected penalties can come down to one overlooked document, a missed regulatory update, or an unguarded moment online. By converting resident accounts to NRE or NRO as the law mandates, understanding how attestation and documentation protect you, and actively monitoring regulatory changes, NRIs safeguard both their assets and their peace of mind. Real-life cases show how easily costly FEMA violations and banking freezes can derail even careful financial plans, making education and action non-negotiable. But this journey isn't just about risk or paperwork. With proactive planning, leveraging technology from secure banking apps to AI-driven investment platforms, and using international treaties to avoid double taxation, NRIs turn compliance into opportunity. Remaining informed and adaptable means you're not reacting to change, you're harnessing it for yourself and future generations. Ultimately, the empowered NRI is the one who treats cross-border finance as a constantly evolving adventure, not a static chore. Diligence, tech-savvy habits, and continuous learning can transform complexity into growth, security, and true global freedom for you and your family. If this video was helpful, like this video, hit subscribe, and share this with your NRI friends. See you in the next one.